Gold still needs, in my opinion, needs two closes above 4,800 to reverse everything. But one of the reasons why 4,400 is also a good area now is that's where the 200-day moving average is now. I don't think gold's going to violate the 200-day moving average. Let's remember this. People have a short memory, even some of you, because I know a lot of your readers are very much into the metals and all. When gold last touched 200-day moving average was in 2023 when gold was just around 2,100, 2,200. After it touched it, went up almost 150% in 14 months or something of that nature. We're close to that bottom phase. It's still tied, unfortunately, to what's happening in the Middle East stock market.
Gold should have a price target of $4,800, but $4,400 is not a bad case. Gold's retreat from record highs has intensified debate as prices weaken despite rising geopolitical tensions and continued concerns about inflation. The decline below the psychologically important $4,500 level has unsettled many investors who only months earlier viewed precious metals as unstoppable. The discussion surrounding gold and silver increasingly centers on sentiment, technical positioning, and the broader relationship between commodities and financial markets. Veteran Wall Street analyst Peter Grandich believes the metals sector is moving through a necessary correction after a powerful surge that created excessive optimism earlier in the year. According to this interpretation, the rapid enthusiasm surrounding gold and silver resembled the emotional behavior often seen during speculative market phases, where investors become convinced prices can only move higher. That optimism has now faded considerably. Sentiment toward precious metals has weakened as prices corrected sharply from their highs. However, the retreat has also reduced speculative excess and returned positioning to more balanced levels. The argument presented by long-term market observers is that this reset may actually strengthen the foundation for future advances rather than signal the end of the trend. Technical levels have become increasingly important in this environment. Analysts have focused closely on the region near $4,400 in gold, which coincides with the 200-day moving average, a widely followed long-term indicator. Historically, gold has often stabilized around this level during broader bull markets before resuming upward momentum. Market participants point to previous cycles where touching the 200-day average preceded significant rallies over the following year. If you enjoyed this analysis, be sure to like the video, subscribe to the channel, and share it with others following these market developments closely. We'll continue delivering in-depth insights, informed perspectives, and conversations that help make sense of the shifting landscape. Thanks for being with us.
So when we last talked, I talked to you about 4,400 as I thought would be the bottom in gold, which so far it's been. What's been quite interesting and learning phase for me, even after 42 years in the business, and that's the continuously being more positive on silver than gold, but it's deserving so. It is clearly trading better than gold. It has as good a fundamental argument at this point in time, and it's leading gold at this point in time. Gold still needs, in my opinion, needs two closes above 4,800 to reverse everything. But one of the reasons why 4,400 is also a good area now is that's where the 200-day moving average is now. I don't think gold's going to violate the 200-day moving average. Let's remember this. People have a short memory, even some of you, because I know a lot of your readers are very much into the metals and all. When gold last touched 200-day moving average was in 2023 when gold was just around 2,100, 2,200. After it touched it, went up almost 150% in 14 months or something of that nature. So we're close to that bottom phase. It's still tied, unfortunately, to what's happening in the Middle East stock market. When we get hit, people say, oh, gold's going to go down because people selling it, they need money, all this other stuff and all. And then when it looks like, the war is coming to an end like we see today, even though the U.S. markets are closed, gold and silver had strong overseas markets and all. We're extremely close to the bottom in gold. And to me, the bottom is already in silver. And the metal, I told you that when we started talking a few years ago, I said it was the safest of the three that was not going to have any hard correction. It was just going to be the turtle going up is copper. I mean, copper's $6.40, $6.50. These are numbers that 12, 18 months ago, people couldn't imagine. And so even with much of North America investment communities, especially the U.S., not having any real exposure yet to the metals and all, these metals are all doing well. There's nothing wrong. No major is going to complain about a $4,500 gold price, especially now. Here's something that a footnote to keep in mind for a bullish factor in gold. Just last spring, mining analysts, the mining community, they like to use what they consider an average cost what a major will have in terms of what it is to produce an ounce of gold. It was around 2,200. In about a year, they're now using 3,400. They think that's a better fair average for gold now. I've never seen the average go up 50% or wherever it was from in a year. So there is a stronger tone to the metals. It may not be everybody sees it because remember, the financial network are never ever going to speak on a regular basis positive about gold and silver. It's kryptonite to them. It flies in the face what they make their living all day selling financial assets and all. And so the very fact that undertones the industry itself, all the things we're seeing on shortages, inabilities to get a whole bunch of different metals now that we need in such desperation, the corrective phase that was necessary for gold to go through, it's finishing it up. I think silver's already done it. I think copper is just has its own dynamics. And I just think that we have less chance. I think our job as financial advisors is the first job is not to lose money. First is trying to make a lot of money. And I think there's far less of a chance now if someone bought an ounce of gold that they would lose a large percentage of their money. But I think that's possible now in things like AI and these stocks and all these other type of things that have gone up 100, 200%, in a year or less.
Silver is being viewed differently. While gold continues to consolidate, silver has shown relative strength and stronger momentum characteristics. Some analysts argue that silver's industrial role gives it additional support beyond monetary demand, especially as investment continues flowing into energy infrastructure, electronics, and advanced manufacturing technologies. This combination of industrial and financial demand has helped silver recover investor confidence faster than gold during the recent correction. Copper has also emerged as a major focus within the broader metals sector. Prices near historic highs reflect increasing concern about future supply shortages as electrification projects, artificial intelligence infrastructure, and industrial modernization accelerate worldwide. Unlike speculative technology shares, copper's gains are tied directly to physical demand and long-term structural shortages. This has strengthened the argument that industrial metals remain supported even while broader financial markets appear increasingly fragile. The contrast between metals and equities has become more pronounced as concerns about stock market valuations continue growing. Critics of the current equity rally argue that earnings expectations have been repeatedly lowered, allowing companies to report results that appear stronger than underlying conditions actually justify. Elevated price-to-earnings ratios, particularly among technology companies connected to artificial intelligence themes, have fueled fears that portions of the stock market are operating on optimism disconnected from economic fundamentals. Let's get back to the video.
Gold's a good leadway in this. So think about when we first got to 4,500 in gold. Man, everybody was excited. In fact, we were starting this parabolic rise, and of course, I exited when we got over 5, but everywhere you turned, people were bullish. Now, many of those same people at 44, 40. The other thing that you have to understand about the stock market, the psyche of the market now, it's that craps game where 7 has been taken away out of the dice. We can't miss. You had to be in those type of feelings when they're going on. That's where the stock market is now. And that little bit that lasted in gold at the beginning of the year, because we did have a psyche. That's why we had the parabolic in gold and silver. We had rocket ships. Every 4 posts that you looked on the internet is silver going to the moon and all. Virtually all gone again. Sentiment numbers have returned almost back to, oh man, I'm never going to make money in gold and silver, these type of conversations. And you have to put sentiment factors into your decision-making on things. And when most people, people don't like hearing this, and it's going to sound like a little bit of an ego for me, but most people don't succeed. Most people only do well in the middle. But they tend to not get in early enough, and they stay too late in something. And that's why you have to use sentiment indicators to have judgments and all. And the sentiment indicator in the stock market is off the charts. And in gold and silver now, it's back to reasonable levels where whatever corrective phase that we've gone through, much of it is behind us. It's behind us in silver, by the way. I still think gold needs to do a little work. At the end of the day, inevitably, the stock market will return to fundamentals. And the fundamentals are always interest rates, inflation, earnings, growth, things of that nature. When you take away just the actual performance and you look at all those, the only other positive that you can make is there has been, in a narrow group, significant earnings, but it's been with trickery. And what I mean by that is Wall Street got very smart in recent years. Analysts, this is my interpretation, there's no set rule in this. This is me looking at it, and there'll probably be some others that may agree. They've lowered their bar on their earnings estimate so they can create what they like to call, hey, beats. In fact, one of the financial networks spends 5 days a week when markets are trading, after the market closes, going through reports on earnings. Did they beat? And, and they come in and all. And so they created a feeling that things are doing better than they really are. Analysts, and I've talked to the few that I have known for years, who've tried not to fall into that trap but been pressured into it in order to interpretate as if things are much, much better than they are. But when you start seeing companies like Walmart, it's almost like a supermarket. There's not big profit margins and all that, and start trading at multiples 2 to 3 times higher than normal multiples, and start making up reasons, let alone when we're looking at things that are trading at, 300 times PE, 200 times revenue sales, 30 times book value. That's all tossed aside. That's why Warren Buffett, who you talked about how do people handle it, that's why he's been a net seller. He's stuck to that belief that things will still be like they used to be. It's not different this time. It may have came about somewhat different, but the end result is not going to be different. And that's the camp that I'm in. And that's why I was willing to, at this point in time, say to myself, enough is enough. This is an area now where I should at least attempt to profit from a potential, bubble bursting.
The concern is not necessarily that economic collapse is imminent, but rather that markets may be underestimating risks linked to interest rates, slowing growth, rising production costs, and persistent inflation pressures. Within the gold sector itself, another important development has emerged through rising mining costs. Industry estimates for the average cost of producing an ounce of gold have climbed dramatically over the past year. That increase suggests that even with recent corrections, the economics supporting higher long-term gold prices may remain intact. Higher production costs can limit future supply growth, especially if mining companies become more cautious about expanding operations. The broader message emerging from the metals market is less about immediate price targets and more about changing financial conditions beneath the surface of global markets. Precious metals no longer appear driven solely by short-term fear or crisis headlines. Instead, they increasingly reflect deeper concerns involving industrial demand, resource scarcity, inflation management, and confidence in financial assets. As volatility reshapes investor behavior and traditional market assumptions face growing pressure, whether this correction represents the end of the metals cycle or merely the quiet beginning of a far larger structural shift still unfolding across the global economy. Stay connected for thoughtful, data-focused analysis covering the evolving financial landscape. Make sure to like the video and subscribe to the channel so you can keep up with our latest weekly discussions and insights. We truly appreciate your support and hope you find this video informative and worthwhile.